Schmidt, and this is my partner, Steve Higgins. Inflation, interest rates, and geopolitics are currently driving volatility early in 2022. The market as measured by the S&P 500 is currently trading about 10% below the all-time high that was set on January 4th. This technical correction started off with investor concerns surrounding inflation and increasing interest rates, but has now shifted to geopolitical concerns about the Russian invasion into Ukraine. While inflation, the Fed tightening, and geopolitical risks are not necessarily new, they are concerns that investors have not had to face in quite some time. And we're seeing that unsettling reality play out in a volatile stock market since the beginning of the year.
While we don't know what's next for each scenario, according to Behavior Analytics, stock market drawdowns from geopolitical shocks have historically averaged about 5%, with the recovery lasting less than 2 months. But at the end of the day, we're not sure how this time will play out.
And despite uncertainty and a slightly different set of market decline headlines, we believe this market decline is very normal. When we build client portfolios, we anticipate this type of market movement occurring about every 12 to 24 months. And when we look back, our last market correction was in September of 2020. So by most measures, this one is right on time.
And we don't want to discount the current environment or the human toll, but we do understand how unsettling market movement can be for our clients. And when we take a step back and we look at history, similar market corrections, and even significantly worse market declines, they become part of the normal course of stock investing and part of the narrative. This is why we created a very intentional, tactical investment management process that enables us to reduce risk when markets are going up, such as last year, and actually seek opportunity when markets are falling, such as the beginning of this year. At the end of the day, we want to make sure that you have at least, if not slightly more stock at the bottom of a correction than you did at the top. That ensures that your account will recover appropriately.
Your portfolio is not built to avoid these market corrections or even bear markets, but really to navigate them. And since the beginning of the year, you've probably seen the trade confirmation in your inbox to show that as a part of our process, we reduced risk exposure right at the end of the year, and then we made our first tactical buy across all of our accounts when the S&P 500 ticked 10% below its all-time high. You can trust that we will continue to monitor the market movement and take advantage of the opportunities that are presented. This will be in the form of tactical stock purchases, tactical income withdrawals, and also potentially Roth conversions.
Right, and we certainly don't know what will happen over the next days, next few weeks, or even the next months. But we do think it is important to focus on where you will be 2, 3, even 5 years from now. What's ultimately important is that we focus on your goals, and we believe you'll be in a better position down the road than you are today. My name is Steve Higgins. Again, this is my partner, Allison Schmidt. We are the advisors here at Higgins & Schmidt Wealth Strategies. Thank you so much for watching.